Welcome to your personalized deep dive. Today we're tackling the whole world of investing, especially during, turbulent times like these. You send over a bunch of articles and notes, and it seems like you're really trying to wrap your head around what's going on in the market right now with all this talk of a government detox period. And then on top of that, you want to figure out some smart moves to protect what you've invested. So help me out here. This is your bread and butter. Where do we even begin to unpack all of this?
Well, I think a good place to start is with what's actually causing all this market turbulence in the first place. It really does feel like we're on a bit of an economic roller coaster right now. And one of the big factors is this shift in government spending. So this detox period that everyone's talking about is essentially the government trying to, get its financial house in order.
Okay, so detox period equals government trying to rein in spending.
Yeah.
Got it. But, what does that actually mean for everyday investors, you and me?
Well, the government has been running on a pretty big deficit. We're talking trillions of dollars here. And this detox means that they're trying to cut back. So kind of like cutting back on sugar, right? Good for you in the long run. But it might mean some discomfort in the short term. And this discomfort can translate to, market jitters, creates uncertainty for businesses and investors.
Yeah, that makes sense. I'm seeing some pretty specific numbers in these articles, too, like $1 trillion deficit
Yeah.
and projections about how this could impact the economy as a whole. Honestly, it is a bit overwhelming. But wait a minute. I'm also seeing some mentions of opportunities, right, amidst all this chaos.
Absolutely. Even in uncertain markets like the one we're in right now, savvy investors can find ways to not just survive, but actually thrive. For example, one of the sources you sent highlights healthcare as a potentially strong sector during this period. And this actually ties in nicely with your own interest in medical technology.
No, that's interesting. So how does that connect? I mean, healthcare being a good bet and my interest in medical technology?
Well, think about it this way. Even if the government cuts back on spending, people still need healthcare.
Right.
It's a necessity, not a luxury. And plus, the healthcare sector is constantly innovating, especially in areas like telehealth and personalized medicine, which, you're already following closely. So all that suggests that this sector could be somewhat insulated from the broader market turbulence that we're seeing.
I see what you mean. It's like those companies are on a different track altogether, maybe even benefiting from the changes that are happening elsewhere.
Exactly. Now, another source you sent points to some specific opportunities within healthcare. Like Amgen, I know you highlighted them in your notes. What specifically caught your eye about them?
Well, I think I remember reading about their strong pipeline of new drugs
Hmm.
and their solid track record of paying dividends. So I guess I was thinking they might be a relatively safe bet in a turbulent market like this one.
That's a good observation. And it plays into what we were discussing earlier about safety stocks. These are companies that tend to hold their value, even when the market is down, kind of like shock absorbers for your portfolio. And Amgen, with its established presence in the pharmaceutical industry, could fit that bill perfectly.
Okay, so Amgen is a potential safety stock. What other strategies are we seeing in these sources?
One interesting point is the idea of exploring ETFs, exchange-traded funds. These are like baskets of stocks that track a particular sector or index. For example, there's the XLV ETF, and this one tracks the healthcare sector. Think of it as a way to, diversify your investments within healthcare without having to pick individual stocks.
Wait, hold on a second. Back up. ETFs. I hear that term thrown around all the time, but honestly, I'm not entirely sure what they are. Can you break that down for me a little bit?
Absolutely. So an ETF or exchange-traded fund, it's essentially a way to invest in a basket of assets all at once. So that can be stocks or bonds. Think of it like a pre-made portfolio. So instead of buying shares in, let's say, 10 different healthcare companies individually, you just buy shares in an ETF that tracks the whole sector. This gives you instant diversification and can be a more convenient way to invest in a particular area of the market.
Okay. Yeah, that makes a lot more sense. So XLV ETF, that one's focused specifically on healthcare stocks. Got it. So we've got safety stocks like Amgen, and then we've got these ETFs like XLV for broader exposure to the healthcare sector. What other areas are these experts pointing to?
Well, you mentioned that you're interested in real estate, and it seems like your instincts are spot on. Several of these articles highlight real estate as a potential haven during times of market turbulence, like what we're seeing now.
Really? What is it about real estate that makes it so appealing in a shaky market? I mean, isn't it vulnerable to economic downturns too?
Well, while real estate can definitely be affected by economic cycles, it also has certain advantages. It's a tangible asset. It's something concrete. It provides a necessary service shelter. People always need places to live and work. regardless of what's happening, on Wall Street.
Right, that makes sense. Even if the stock market's going haywire, people still need roofs over their heads.
Yeah.
But where do we even begin to look for opportunities? I mean, within the vast world of real estate.
One specific area that's mentioned is industrial properties. So think warehouses, distribution centers, and things like that. These types of properties are really essential for the functioning of the economy as a whole. And we're actually seeing increased demand for them because of the growth of e-commerce and supply chain logistics.
So even with this government detox and the potential for some economic slowdown, the need for these industrial spaces, it probably won't go away anytime soon.
Exactly. In fact, the shift toward online shopping and the need for efficient supply chains, those things could even make these properties more valuable over time.
That's a good point. I see a specific company mentioned here, Plymouth Industrial REIT. Now, I have to admit, REIT is another one of those financial terms I'm not entirely clear on. Can you shed some light on what that means?
Of course. REIT stands for Real Estate Investment Trust. It's basically a company that owns, operates, or finances income-generating real estate. Think of it as a way to invest in real estate without actually buying properties yourself.
So by investing in Plymouth Industrial REIT, I'd essentially be getting exposure to that industrial real estate market without having to go out and buy a warehouse myself. That's pretty cool. But what makes REITs particularly attractive during this detox period that we keep talking about?
Well, REITs are known for paying out a significant portion of their income as dividends. This can provide a steady stream of income for investors, even if the stock market is experiencing volatility.
So it's like a built-in cushion
Yeah.
against those potential market downturns. Okay, that makes sense. So far, we've covered some promising areas, healthcare and industrial real estate. What other opportunities are these experts highlighting?
Well, one thing that stands out is the potential of I-bonds, which are government-issued savings bonds that offer a guaranteed return, and that return is adjusted for inflation.
I-bonds. That sounds intriguing, especially with all the talk about inflation these days. I have to admit, I'm not very familiar with them. Could you explain a bit more about how they work?
Sure. So I-bonds, they're a type of savings bond that are issued by the U.S. Treasury. And what makes them unique is that their interest rate has two components. So there's a fixed rate that stays the same for the life of the bond. And then there's a variable rate that's adjusted twice a year based on the current inflation rate.
So if inflation goes up, the return on my I-bonds goes up too. That
Yeah.
sounds like a pretty good deal, especially in an environment where inflation is a concern.
Exactly. It's a great way to hedge against rising prices and protect your purchasing power. The only catch is that you have to hold them for at least a year before you can cash them in without penalty.
A year-long lockup. So it's like a guaranteed return, but with a little bit of a patience requirement. Okay, I-bonds. I'm adding that to my mental list of things to explore further. When we first started talking about this detox period, I was a bit apprehensive, honestly. But now that we're, digging into these potential opportunities, I'm starting to feel a bit more optimistic.
That's the spirit. It's important to remember that even during periods of economic uncertainty, there are always smart moves you can make to not only protect your wealth, but grow it as well.
Absolutely. And speaking of smart moves, I keep seeing mentions of fintech in these articles. It seems like this sector is still considered a hotbed for growth, even amidst all the market turbulence we've been talking about. Why is that?
That's a great question. Fintech, which stands for financial technology, is essentially the use of technology to improve and automate financial services. So think online banking, mobile payment apps, robo-advisors, even cryptocurrency.
Right. So instead of walking into a traditional bank, we're now managing our money on our phones or computers.
Exactly. And this trend is only accelerating, even with the current economic uncertainty. In fact, some would even argue that fintech is actually poised to benefit from this detox period that we've been discussing.
Oh, how so?
Well, think about it this way. If the government is cutting back on spending, it could lead to reduced funding for those traditional financial institutions. And this could actually create an opening for innovative fintech companies to step in and offer alternative solutions.
I see. So it's like the classic story of disruption, the old guard facing challenges while these nimble newcomers seize the opportunity. But what specific areas within fintech are we talking about here?
One area that's getting a lot of attention is digital payments. As more and more commerce moves online, the demand for secure and efficient digital payment solutions, well, it's skyrocketing.
Makes sense. I mean, I barely use cash anymore. It's all
Mm.
credit cards, mobile payments,
Mm.
online transactions.
Exactly. And this shift towards digital payments is creating huge opportunities for fintech companies that are developing innovative payment platforms and technologies.
So even if traditional banks are facing headwinds from this government detox, companies focused on these digital payments could actually thrive.
It's definitely a possibility. Remember, disruption, it often happens fastest during times of change and uncertainty.
This is all incredibly insightful. So far, we covered a lot of ground. The reasons for this market turbulence, the concept of a government detox period, and then some potential opportunities in areas like healthcare, real estate, and now fintech. But there's one thing I'm still grappling with. I'm trying to connect the dots between these specific opportunities and the bigger picture. How does this detox period, with all its potential challenges, how does it fit into the overall economic landscape?
That's a fantastic question. And that's where things get really interesting. This isn't just about picking, individual stocks or sectors. It's about understanding the underlying economic forces that are shaping the entire market. We're in a period of transition right now. It's a bit like a caterpillar transforming into a butterfly.
Okay, I love that analogy, a caterpillar transforming into a butterfly. So you're saying that this detox period, while, potentially messy and uncertain in the short term, could ultimately lead to a more beautiful and resilient market.
Precisely. You see, for years, we've relied on government spending to kind of fuel that economic growth. But that's, that's not a sustainable long-term strategy. By reducing spending and tackling this national debt head on, we're essentially forcing the economy to become more self-reliant, to stand on its own 2 feet, so to speak. It might be a bumpy ride at first, but it has the potential to lead to a more stable and robust market in the future.
It makes sense, like we're weaning ourselves off of a crutch
Mhm.
and learning to walk on our own. But I have to admit, I'm also seeing some concerns in these articles about potential negative consequences of this detox period, like a recession or a slowdown in economic growth. How do those factors fit into this whole butterfly analogy?
That's a great point, and it's definitely important to acknowledge those potential downsides. Think of it like this. The transformation process, it isn't always smooth. The caterpillar, it goes through a period of intense change, even appearing to kind of break down before it emerges as that butterfly. Similarly, the economy, it might experience some short-term pain as it adjusts to this new reality of reduced government spending.
Okay, so a recession or a slowdown, it's not out of the question. That's a bit sobering, but I appreciate your honesty. But how do we, as investors, navigate this potentially turbulent period? I mean, we've talked about some promising sectors and strategies, but what about specific actions, things we can do to protect ourselves from potential losses?
Well, you've already hit on one of the key strategies, diversification.
Right.
Don't put all your eggs in one basket, as the saying goes. Spread your investments across different asset classes, different sectors, even geographic regions. This helps to mitigate risk. And it ensures that even if one area of the market takes a hit, your entire portfolio isn't wiped out.
Right. Diversification. That's investing 101. But it's so easy to forget when you get excited about a particular stock or sector. So spreading our investments across different areas, that's key. Are there any other specific strategies that you'd recommend?
Absolutely. One approach is to consider adding some safety stocks to your portfolio. We touched on this a little bit earlier with Amgen, but it's worth reiterating. These are stocks that tend to hold their value even when the market's down. They provide a bit of stability during turbulent times.
So even if, the tech sector takes another tumble, these safety stocks, they might help cushion the blow.
Exactly. Think of them as your portfolio's shock absorbers. In addition to Amgen, another company that's mentioned in your sources is Eli Lilly. They're another well-established pharmaceutical company
Mm.
with a long history of weathering economic storms.
Interesting. So healthcare, it seems to be a recurring theme here. Both Amgen and Eli Lilly, they're in that space. Is there something about the healthcare sector that makes it particularly resilient during times of economic uncertainty?
There are a few factors at play here. First, as we discussed earlier, healthcare, it's a necessity, not a luxury. People will always need medical care, regardless of, what the economic climate's doing. Second, the healthcare sector, it's constantly innovating, developing new drugs, new treatments, new technologies, and this constant innovation, it can actually help to drive growth, even during periods of economic slowdown.
Makes sense. So while other sectors might be struggling, healthcare could be chugging along steadily, maybe even benefiting from the increased demand for new and innovative solutions. Okay, so safety stocks are on the list. What other strategies should we be considering?
Another approach is to look for value stocks. These are companies that are currently undervalued by the market, meaning their stock price is lower than their intrinsic worth. Think of it like finding a hidden gem at a flea market, something valuable that everyone else is overlooking.
That's a great analogy. So it's like bargain hunting in the stock market.
Yeah.
But how do you even identify these value stocks? It seems like everyone's always claiming to have found the next undervalued gem.
Well, it takes careful research and analysis, but there are some key indicators to look for. One is a low price to earnings ratio, which compares a company's stock price to its earnings per share. A low PE ratio, it can suggest that the stock is undervalued relative to its earnings potential.
So a low PE ratio, that could be a sign of a potential value stock. Are there any other red flags, I guess green flags in this case, that we should be looking for?
Another thing to consider is a company's debt-to-equity ratio, which measures how much debt a company is using to finance its assets relative to the amount of equity it has. A low debt-to-equity ratio indicates that the company is financially healthy and not overly reliant on borrowing.
So a low PE ratio and a low debt-to-equity ratio. Those are two potential signs that a company might be undervalued by the market.
Got it. Now, you mentioned value stocks and safety stocks. Are there any other specific companies mentioned in these sources that fit those categories?
One company that's mentioned as a potential value stock is Advanced Micro Devices, or AMD. They're a major player in the semiconductor industry. And their stock is currently trading at what some analysts consider a bargain price.
AMD, interesting. I've definitely heard of them. They make processors for computers, right?
Exactly. And with the increasing demand for computing power, from gaming to artificial intelligence, AMD is well positioned to benefit. Right. And the fact that their stock is considered undervalued just adds to their appeal. Okay, so we've got AMD on the value stock radar. Anything else catching your eye in these sources?
Well, remember those I bonds we were discussing earlier? Those are worth considering as well. They're not technically stocks, but they offer a guaranteed return that's adjusted for inflation, which can be a great way to protect your purchasing power, especially during times of economic uncertainty.
Right. I bonds. It's like a safety net for your money. Guaranteed return, protection against inflation. What's not to like?
Exactly. The only thing to keep in mind is that you have to hold them for at least a year before you can cash them in without penalty.
Right. That's true. But if you're thinking long term, that shouldn't be a major issue. Okay, so we've got safety stocks, we've got value stocks, and we've got I bonds. It seems like there's a whole arsenal of tools at our disposal to navigate this detox period. But there's one area I'm still curious about.
And what's that?
We talked about real estate as a potential safe haven, right? During market turbulence. And you mentioned industrial properties as a particularly promising segment. But I'm also seeing some chatter in these sources about the healthcare real estate sector. What's the story there?
That's a great observation. Healthcare real estate is another area that's considered relatively resilient. Even during economic downturns, think about it. Even if the economy slows down, people, they still get sick, they still need medical care, they still require specialized facilities.
Right. Hospitals, clinics, medical offices. I mean, those are essential services that aren't going away anytime soon.
Exactly. And as the population ages and the demand for healthcare services, it continues to grow, the need for healthcare real estate is only expected to increase.
Interesting. So investing in healthcare real estate could be a way to kind of tap into a growing market while also enjoying some degree of insulation from that broader economic volatility.
That's the general idea. And there are a couple of specific companies mentioned in your sources that focus on this sector. One is Medical Properties Trust. They own and lease hospitals and other healthcare facilities.
Medical Properties Trust.
Yeah.
Got it. So they're like landlords for the healthcare industry. That's a pretty interesting niche.
It is, and it aligns perfectly with what we were discussing earlier about investing in essential services, those services that are less vulnerable to economic downturns.
Okay, so we've got Medical Properties Trust on the healthcare real estate front. Are there any other companies mentioned in these sources that are worth a closer look?
One other company that stands out is Welltower. They focus on senior housing and other healthcare properties that cater to an aging population.
Well, Tower, I'll add that to my research list as well. So it seems like there's no shortage of potential opportunities out there, even amidst all this talk of a government detox period
Yeah.
and potential market turbulence. But I have to admit, with so many options, it it's a bit overwhelming. How do we even begin to narrow it down and make sense of it all?
That's a great question. And that's where your own personal financial goals and your risk tolerance, that's where those come into play. There's no one size fits all approach to investing. What works for one person might not work for another.
Right, that makes sense. So it's not just about following the latest hot tips or chasing the highest returns. It's about aligning our investment choices with our own individual circumstances and goals.
Exactly. And that's where doing your own research, carefully considering the risks and potential rewards of each investment, and seeking advice from a qualified financial advisor if needed, that's crucial.
Okay, so due diligence is key. Don't just jump into anything blindly. Take the time to understand the investment, the company, and how it fits into your overall financial plan.
Precisely. Remember, knowledge is power. And the more informed you are, the better equipped you'll be to navigate the complexities of the market and make those sound investment decisions.
Hmm. That's great advice. So we've covered a lot of ground today, from the causes of this market turbulence and the implications of this government detox period, to specific investment strategies and potential opportunities in various sectors. But there's one final area I want to touch on before we wrap things up. So we've talked about healthcare and real estate and even fintech, all in the context of this detox period. It's a lot to process, but I feel like we're starting to see a clearer picture of the economic landscape and the potential opportunities that are out there.
Exactly. And I think it's important to emphasize that this isn't just about, surviving this detox period. It's about positioning yourself for long-term success.
Yeah, I like that. It's not just about weathering the storm. It's about coming out stronger on the other side.
Yeah.
But how do we actually do that? What are some concrete steps that we can take to not only protect our investments but also set ourselves up for future growth?
Well, one of the most important things is to understand that this detox period is likely to accelerate certain trends that were already underway. For example, the shift towards digitalization and automation, that's only going to intensify as businesses and governments, look for ways to cut costs and improve efficiency.
So it's like this detox period is acting as a catalyst, pushing us faster towards a more digital and automated future. But what does that actually mean for investors? Where should we be looking for opportunities in this evolving landscape?
One area that really stands out is cybersecurity. As more and more of our lives and our businesses move online, the need for robust cybersecurity solutions, well, it's only going to grow. And this detox period with its focus on reducing government spending could actually create more opportunities for private sector cybersecurity companies to kind of step in and fill the gap.
Cybersecurity. Yeah, that's a sector you highlighted in your notes, and it's just mentioned in a couple of the articles you sent over as well. I have to admit, it's not an area I've given a lot of thought to before. Can you tell me a little bit more about why cybersecurity is such a promising investment opportunity, especially in the context of this detox period?
Of course. So think about it this way. As governments, they tighten their belts, they may actually have to scale back their own cybersecurity investments, leaving potential vulnerabilities. And this creates an opportunity for those private sector companies that specialize in cybersecurity to step in and provide that necessary protection.
So it's like a supply and demand dynamic. As government spending on cybersecurity decreases, the demand for private sector solutions, well, that increases, and it creates potential opportunities for investors. That makes sense. But cybersecurity, it seems like such a vast and complex field. I mean, where do we even begin to look for investment opportunities?
One way to approach it is to focus on specific areas within cybersecurity that are experiencing particularly strong growth. For example, cloud security is a really hot area right now as more and more businesses migrate their data and operations to the cloud.
Cloud security. Okay, so companies that specialize in protecting data and applications that are stored and accessed in the cloud. Got it. But what about specific companies? Are there any names that stand out in this space?
One company that's often mentioned is CrowdStrike. They're a leader in cloud-native endpoint security, which basically means they protect devices like laptops and smartphones that are connected to the cloud.
CrowdStrike, I'll add them to my research list. So cloud security and CrowdStrike.
Right.
What other areas within cybersecurity are worth exploring?
Another area that's seeing a lot of activity is identity and access management, or IAM. This involves technologies that verify the identity of users and control their access to sensitive data and systems.
Identity and access management. Okay, it sounds like that's becoming increasingly important as cyber attacks become more sophisticated and targeted.
Exactly. And one company that's a leader in this space is Okta. They provide cloud-based identity solutions that help businesses secure their workforce and their customers.
Okta, got it. So we've got CrowdStrike for cloud security and Okta for identity and access management. Any other cybersecurity companies catching your eye?
One more company that's worth mentioning is Palo Alto Networks. They offer a wide range of cybersecurity solutions, including firewalls, threat prevention, and cloud security.
Palo Alto Networks. Okay, they seem to be more of a one-stop shop for cybersecurity needs. So we've got a good starting point for researching cybersecurity investment opportunities. What other sectors are we seeing mentioned in these sources as being potentially well positioned for this detox period?
Well, you mentioned earlier that you're interested in the intersection of technology and healthcare, and one sector that fits that bill perfectly is health tech, which we touched on briefly before. It's a broad category that encompasses a wide range of technologies and services aimed at improving healthcare outcomes and efficiency.
Health tech, yes, that's definitely an area I'm fascinated by. But how does it tie into this whole detox period narrative? Wouldn't it be vulnerable to cuts in government healthcare spending?
That's a valid concern. However, health tech also has several factors working in its favor. First, it has the potential to significantly reduce healthcare costs by streamlining processes, improving patient engagement, and enabling more preventative care. And that's something that both government and private insurers are eager to embrace, especially during a time when healthcare costs are rising so rapidly.
So even if healthcare budgets are being tightened, health tech could be seen as a way to save money and improve efficiency, making it a potentially attractive investment even during this detox period.
Exactly. And second, health tech, it aligns perfectly with the growing consumer demand for personalized, convenient, and accessible healthcare services. People are increasingly taking control of their own health and well-being, and they're looking for technologies that can empower them to do so.
Right, it's like the whole trend towards self-tracking and monitoring
Mhm.
with wearable devices and health apps. People want to be more proactive about their health, and health tech is providing the tools to do that. But what are some specific areas within health tech that are particularly promising from an investment perspective?
One area that's attracting a lot of attention is telehealth, which we discussed a bit earlier. This involves the use of technology to deliver healthcare services remotely, such as virtual doctor visits, remote patient monitoring, and online mental health counseling. And it's a sector that's experienced explosive growth during the pandemic, as people sought ways to access healthcare safely and conveniently from their homes.
Telehealth, yeah. That makes so much sense. I've even used telehealth services myself a few times.
Mm.
It's so much easier than trying to schedule an in-person appointment, especially for routine checkups or minor ailments. But what about the long-term prospects for telehealth? Will it continue to grow even after the pandemic is over?
That's a great question, and the consensus among experts is that the telehealth is here to stay. The pandemic, it accelerated the adoption of telehealth, and many people have now experienced the convenience and accessibility that it offers. Plus, telehealth, it aligns perfectly with those broader trends towards digitalization and consumer empowerment in healthcare.
Right. It just makes sense in today's world. But are there any specific companies in the telehealth space that are worth considering from an investment perspective?
One company that stands out is Teladoc Health. They're one of the largest and most established telehealth providers, offering a wide range of virtual care services.
Teladoc. I've definitely heard of them. I'll add them to my research list.
Yeah.
So telehealth and Teladoc. What other areas within health tech are worth exploring?
Another area that's generating a lot of buzz is artificial intelligence or AI in healthcare. AI is being used to develop everything from diagnostic tools that can detect diseases earlier to personalized treatment plans that are tailored to individual patients.
AI in healthcare. That's incredible. It seems like AI has the potential to revolutionize the healthcare industry. But is it too early to invest in this space? I mean, is the technology really mature enough to be commercially viable?
That's a valid question, and it's important to be discerning when investing in any emerging technology. However, AI in healthcare, it's already making a real impact, and there are a number of companies that are well positioned to benefit from this trend.
Interesting. Are there any specific companies that you have in mind?
One company that's worth checking out is Intuitive Surgical. They're the maker of the Da Vinci surgical system. It's a robotic assisted surgery platform that's used in hospitals around the world. Their technology is a great example of how AI and robotics are being used to improve surgical outcomes and efficiency.
Intuitive Surgical and the Da Vinci surgical system. That's amazing. It's like something out of a science fiction movie. So we've got Teladoc for telehealth and Intuitive Surgical for AI and healthcare. Any other health tech companies worth a look?
One more company that stands out is Dexcom. They're a leader in continuous glucose monitoring or CGM technology. Their devices help people with diabetes track their blood sugar levels in real time, allowing them to manage their condition more effectively.
Dexcom and CGM technology. That's another great example of how health tech is empowering people to take control of their health.
Okay, so we've covered a lot of ground in the health tech space. Any other sectors we need to touch on before we wrap things up?
Well, one final point I want to make is that this detox period it underscores the importance of thinking long term and focusing on sustainable investment.
Sustainable investments, yeah. That's something I've been thinking a lot about lately. It seems like more and more investors are looking for companies that are not only profitable but also environmentally and socially responsible. But how does that tie into this detox period that we've been discussing? Well, this detox period, it's essentially a time of reckoning for the economy. It's forcing us to confront those unsustainable levels of debt and spending that have been accumulating for years. And it's highlighting the need for a more sustainable and responsible approach to economic growth.
So you're saying that this detox period is actually a wake-up call,
Right.
urging us to think more carefully about the long-term consequences of our economic choices.
Exactly. And for investors, this means looking beyond short-term profits and considering the environmental, social and governance or ESG factors that can impact a company's long-term
Well,
sustainability.
ESG factors. Okay, so it's not just about financial performance anymore. It's about considering a company's impact on the environment. Its relations with its employees and stakeholders,
Yeah.
and its commitment to ethical and responsible business practices.
Precisely. And investing in companies with strong ESG profiles is not only a way to align your investments with your values, but it's also a potentially smart investment strategy in the long run.
So it's like doing good and doing well at the same time. I like that. But how do we even begin to identify companies with strong ESG credentials? Is there a specific rating system or a framework that investors can use?
There are a number of ESG rating agencies and data providers that assess companies based on their environmental, social, and governance performance. Some of the most well-known include MSCI, Sustainalytics, and Bloomberg ESG data. You can also find ESG information on company websites, in sustainability reports, and through third-party research platforms.
Okay, so there are resources available to help investors evaluate companies' ESG performance. That's good to know. So it seems like this detox period, while presenting challenges, is also creating a lot of opportunities for investors who are willing to adapt, think long term, and focus on sustainable investments.
Exactly. And I think the key takeaway here is that this is not a time to panic. or to make impulsive decisions. It's a time to stay informed, to be strategic, and to focus on the fundamentals.
That's a great message to end on. Thank you so much for taking this deep dive with us today. You've provided some incredibly valuable insights and given us a lot to think about.
My pleasure. I hope this conversation has empowered you to approach investing with more confidence and clarity.
It absolutely has. And to our listener, remember, knowledge is power. Use the information we've discussed today as a starting point for your own research and decision making. Stay informed, stay engaged, and most importantly, be optimistic about the future. That's it for today's deep dive. Happy investing.